Imagine you are at a school carnival. There is a giant booth where everyone buys soda, but there is a catch. The price of a soda changes every single hour. To decide the price, the three biggest kids in school meet behind a curtain. They don't look at how much the soda actually costs to make. Instead, the teacher asks them a simple question. How much would it cost you to borrow $1 from each other right now? The three kids huddle up. They whisper. Then they shout out a number. 1 ticket. And so, for the next hour, every student in the school has to pay 1 ticket for a soda. But what if those three kids realized something? What if they realized that if they shouted 2 tickets, they could make their friends who own soda stands rich? And what if they realized that by lying about that one tiny number, they could secretly control how much every student in the school spent on lunch, bus rides, and even their homework supplies? This isn't a story about a school carnival. This is the story of the Libor scandal. It is the story of how the world's biggest banks took the price of money, turned it into a toy, and used it to rig a $350 trillion game. That is 350, followed by 12 zeros. It is more money than actually exists in physical cash on the entire planet. And for decades, a small group of guys in expensive suits were moving that number up and down just because they felt like it. To understand how they did it, we have to understand the magic number. In the real world, this number is called a Libor. It stands for the London Interbank Offered Rate. It sounds boring, right? That's exactly what the bankers wanted you to think. If a word sounds boring, you won't ask questions about it. But Libor is the most important number in your life that you've never heard of. It's the interest rate that banks charge each other to borrow money. Here's the problem. The most important number in the global economy was based entirely on the honor system. Every morning at 11 a.m. in London, a group of massive banks, names you know like Barclays, UBS, and Deutsche Bank, would answer a survey. The survey asked, how much would it cost you to borrow money today? There was no proof required, no receipts, no bank statements. The regulators just assumed these billion-dollar banks would tell the truth because, well, they were reputable. But in the world of high finance, a reputation is just a mask you wear while you reach for someone else's wallet. The banks realized that if they reported a low number, it made them look strong. It told the world that everyone trusts them so much that they lend them money for almost nothing. But if they reported a high number, it made them look like they were in trouble. During the 2008 financial crisis, when banks were actually collapsing, they started lying through their teeth. They all reported low numbers to hide the fact that they were terrified and broke. They were lowballing the truth just to survive. But then the lying stopped being about survival and started being about pure greed. Inside these banks, there are 2 types of people. There are the submitters, the guys who answer the survey, and there are the traders. The traders are the gamblers. They make massive bets on which way interest rates will move. A trader might have a bet worth $100 million that says interest rates will go up by just 0.01%. That sounds like a tiny change. It's the thickness of a human hair. But in the world of $350 trillion, that tiny hair is worth millions of dollars in profit. So, the traders started doing something incredibly simple. They started asking the submitters for favors. The global economy wasn't being rigged by a complex AI or a secret government project. It was being rigged over coffee, instant messages, and promises of champagne. The investigators eventually found the chat logs, and they read like a group of teenagers planning a prank. One trader messaged a submitter saying, if you keep the rate low today, I'll bring you a bottle of Bollinger champagne. Another message said, dude, I owe you big time. Can you just drop the number by 2 points? It'll make me $200,000. The submitter replied, sure, for you, anything. It was that casual. They were moving the price of mortgages for millions of people in exchange for a bottle of bubbles or a nice lunch. Because Libor decides the interest rate on your house, your car, and your credit card. Every time these guys nudged the number up to help their friends, you paid more. If you had a mortgage in 2005, there is a very good chance that the amount you paid every month was decided by a guy in London who wanted a free bottle of wine. But it wasn't just one bank. It was almost all of them. They were all in on it. They realized that if they all lied in the same direction, nobody would notice. It was a giant circle of lies. If everyone is shouting the same wrong answer, the teacher thinks it's the right answer. This went on for more than 20 years. Trillions of dollars were shifted from regular people's pockets into the bonus pools of the world's biggest banks. And for 2 decades, not a single person stopped them. The scary part is that people knew. As early as 2007, a few whistleblowers and even some officials at the Federal Reserve in New York noticed that the numbers didn't make sense. They saw that the market was in chaos, yet the banks were all reporting that everything was totally fine and interest rates were stable. It was like watching a house burn down while the owner stands out front saying the temperature inside is a comfortable 72 degrees. The Bank of England was warned. The regulators in Washington were warned, but they didn't do anything. Why? Because the entire financial system was built on Libor. If they admitted that the magic number was a lie, the whole system might have collapsed. It was too big to fix. So, they looked the other way. They let the bankers keep playing their game because they were afraid of what would happen if the game ended. Eventually, the lie became too big to hide. In 2012, a massive investigation finally broke the story wide open. Barclays was the first to get hit with a giant fine. Then UBS, then the rest. The world was shocked. People were furious. They wanted to know who the mastermind was. They wanted a villain to point at, and the banks gave them one. His name was Tom Hayes. Tom was a math genius. He was a trader who worked for UBS and later Citigroup. He was diagnosed with Asperger's, and he viewed the world as a giant math puzzle to be solved. To Tom, rigging Libor wasn't a crime. It was just the way the job worked. He was incredibly open about it. He would email everyone, tell them exactly what he was doing, and even ask his bosses for help. When the government finally decided they needed to put someone in jail, they didn't go after the CEOs who made hundreds of millions. They didn't go after the billionaire bank owners. They went after Tom. Tom Hayes became the only person in the UK to be sent to prison for the Libor scandal. He was sentenced to 14 years. The banks paid billions in fines, which sounds like a lot, but to them, it was just the cost of doing business. They paid the fines using the very money they had made from the rigging. No CEO lost their job. No board of directors went to a cell. They just handed the government a check and pointed the finger at the math guy. Tom Hayes later claimed that he was just a pawn in a much bigger game. He said that everyone above him knew exactly what was happening and encouraged it. He was doing his job, and when the light turned on, he was the only one who didn't run fast enough. After the scandal, the world decided that Libor had to die. They said we can't have a system based on an honor system survey anymore. So, they replaced it. They created new numbers with names like SOFR and SONIA. These new numbers are based on actual transactions, real data from real trades. No more surveys, no more lying behind a curtain. But here's the thing. Who is doing those actual transactions? The same banks. The system changed, but the players stayed the same. The price of money is still controlled by a tiny group of massive institutions. They found a way to make the game look more professional, but the power is still in the same hands. Trust in the financial system was broken, and instead of fixing the trust, they just bought a more expensive lock for the curtain. The Libor scandal proved that the global economy is not a natural force like the weather. It is a machine built by people, and people can be bribed with champagne. It showed us that interest isn't just a math formula, it's a transfer of wealth. When the banks rig the rate, they aren't just changing a number on a screen. They are taking an extra hour of work from your day, an extra gift from under your Christmas tree, and an extra year of savings from your retirement. Finance is often described as a science, but the Libor story shows us it's actually a confidence game. It only works as long as you believe the person on the other side of the curtain is telling the truth. So, the next time you look at your credit card statement or see the interest rate on a loan, remember the school carnival. Remember the 3 kids behind the curtain and the bottle of champagne. The global economy is a $350 trillion tower, and for a long time, it was resting on a foundation of lies. The game might be fixed now, but in the world of finance, the house always wins. And if you're not at the table, you're probably on the menu.